As a current or future IT leader, financial literacy is going to be really important as you move your career forward. With financial literacy, you'll be able to gain credibility with your peers outside of the IT organization and spot errors made by your accounting and finance team that might affect your operations or at least your financial results. That's why understanding depreciation is so critical. Even in this as-a-service world, depreciation will still be a significant impact to your IT budget. Hi, I'm Steve Murphy. I'm a Vice President at ARG, and while I work for ARG, this video is my own and not a reflection of my employer. So when you buy a physical asset, let's say you're buying a $10,000 server, that asset gets added to the balance sheet at $10,000 when you buy it. Whether you pay up front with cash or whether you finance it through some sort of debt facility or capital lease. That $10,000 gets added to the balance sheet, and over time, depreciation is recorded against that asset to reflect the use that you're incurring of that asset and the resultant diminished value over time. So let's say we have this $10,000 server and the useful life is 5 years, and I'll get to why that shouldn't be a useful life for a server in this day and age. But let's just say for the sake of easy math, the useful life is 5 years on a $10,000 server. The depreciation on that server is going to be the cost divided by the useful life in years. So $10,000 divided by 5 years. That's $2,000 a year. Now normally your budget will be hit with a monthly depreciation charge, which is just 1/12 of that annual number. So depreciation is the accounting recognition that your asset has aged and that it's no longer as valuable as it has been in the past. Most companies do use straight line depreciation like I just used in the example, where the depreciation is equal in each of the useful life years. But there are other approaches. We'll get to one in just a moment. So when depreciation is recorded, the depreciation expense normally shows up on your IT budget. The other side of that entry, because accountants like to work in dual entry models, the other side of that entry is we have an expense on one side, the other side is accumulated depreciation. That actually shows up on the balance sheet as a contra asset or as a negative asset. So it serves to reduce on a net basis that $10,000 server price that we had recorded earlier. Every year, $2,000 will be added to our accumulated depreciation budget to reflect the diminished value of that asset because it has less useful life left in it. Now this is where depreciation should really be managed by IT leaders. Depreciation of anything technology related over 5 years, unless it's a data center build out or something, is really way too long. We want to depreciate any assets that we're acquiring as quickly as possible. We want to make sure we retain as much flexibility in the future so we can revise our technology strategy and acquire new technologies for the organization without having to write off a book value of an asset that's no longer functional or no longer serving that strategy. In my opinion, when we're doing business cases, your business case should prove out the asset in 3 years or less. And that will allow you to go back to finance and say, hey, my business case shows a positive ROI, return on investment. Within a 3-year period, we should be depreciating this asset that's coming along or that's being acquired in this project for 3 years or less. And that will give you a much shorter time horizon in order for you to, again, get that flexibility back towards the end of the project so you can reevaluate and possibly do something different later on. You want to reduce the value of that asset to zero from an accounting perspective as quickly as possible. Now, if you really want to freak out your financial analyst who's working with you on your depreciation schedule and they're resistant to doing something less than 5 years, because 5 years is the way we've always done it in the organization, ask if you can do an accelerated depreciation schedule. Sure, give me 5 years, but let me do it on an accelerated basis. This depreciates the asset more heavily up front and more likely towards the end, and it reduces that book value much more aggressively than a straight line depreciation method. The analogy that I use for accelerated depreciation is like buying a new car. The moment you drive that new car off the lot, it's a used car. It is worth way less than you originally paid for it a half a mile back. So accelerated depreciation does a lot of the same thing. It allows us to, or it recognizes the fact that what we've just installed in our data center, for example, is now used it is no longer has a new value associated with it. It has more of a used or a secondhand or gray market value, and that can be reflected in an accelerated accumulated depreciation model. Now, depreciation is a non-cash expense, and we'll get into this in another video, but non-cash expenses, especially if you're in an organization that might be acquired in the future, are really important to understand, because generally when you're valuing your company, or some potential acquirer is valuing their company, they're not going to be concerned with non-cash expenses. So there's an advantage to having depreciation on your books if you are looking to be acquired, because it's an expense, yes, but it's not one that will count against you when a potential suitor is valuing your business. Now lastly, amortization. Amortization is the same thing as depreciation, but amortization is applied to intangible assets rather than tangible assets. So in the example with depreciation, our tangible asset was a server. We can put our hands on it. We receive delivery of it. We install it. It runs, and we can point to it at any given point in time. An intangible asset is something like a software license that you can't necessarily point to. You can point to the machine it's running on, but you can't necessarily point to software. Or it's an internal cost that you might have incurred to develop an application internally. These are handled exactly the same way. Amortization is the exact same thing as depreciation, except they're for soft assets or virtual assets or intangible assets. So I hope that was helpful in understanding how depreciation works and how maybe you can manage depreciation within your own IT operations. And once again, having a little bit of financial literacy is really important. So if you got some value out of this video, I'd really appreciate a like, and thank you very much in advance for doing that. And if you want to return to this channel in the future for similar content, the best way of doing that is just by hitting the subscribe button, and you can return to this channel at your convenience. And with that, I appreciate your time, and I hope you have a really great day.